Good evening, everyone. Welcome to the Hidden Edge Pod. I'm Sam. This is Kris. You guys already know us. How was today in the market? Like, I feel like it's been red day after red day after red day, man. Like, just the market's got to chill. I have too many wounds. Like, come on.
I'm okay with it. Okay. I'm pissed off more at this Epstein list because, bro, you know me, I don't sleep a lot, right? My sleep is very important to me. The problem is this damn Epstein list was supposed to come out, and I'm like sitting there waiting, like, bro, I really want to see this list. And then the market's tanking at the same time. Usually on like red days, what I typically do is I look in the morning, be like, yeah, today's gonna be red day, and I just go to sleep. I don't even bother looking. I was like, all right, today's gonna be a sleep day, but I didn't even sleep today, so I'm freaking tired. I got a project that I'm supposed to be working on that's due tomorrow. I told the wife, get me some coffee.
Epstein contact list. What is this about?
It's this stupid thing with basically it was supposed to be like this treasure trove of documents that shows like all these people, like people in power that are, that are complicit in this whole Jeffrey Epstein thing. So I think that's something that I think like it does nothing for the markets, but it's just one of those things that makes you makes you curious.
Yeah.
Like, oh yeah, I wonder where the real power, like who are the real powers here? Like who's actually controlling the government, that
Well,
kind of stuff.
it looks like your cousin, Kash Patel, new FBI director, he's on top of it. So, that's +1 for you guys.
He's not on top of it. That was the whole point of this release because supposedly what happened was the Southern District of New York gave like a bunch of stuff, and they were supposed to release it, but they're like, wait a second, the whole bunch of stuff is actually missing. Like this is nothing. This is stuff that they already released, before. So it was like whatever. So now I'm just like, okay, so you know what? Screw it. I don't care anymore. I'm already out of the picture. I think we can just focus on the markets because I think that's the most important thing.
What markets? Oh, you mean that thing that's
exactly.
down like every single day for God knows how long?
For 5 days. I mean, you know how it is with the markets, man. Yeah, way that it works is when things are going down, it's like an elevator. When things are going up, it's like an escalator, right? Yeah. So right now, I think there's a lot of fear in the markets. People are getting, kind of jostled by even some minor comments like on X. I just posted like a funny thing today. Well, at least I thought it was funny. It was like all the gains since Trump joined, Trump got elected have been wiped out. Right. And then I wrote, hey, Donnie, I'm tired of winning. And so everyone's like in the Twitter section, either really, really pissed off. They're like, see, you voted for this clown, so now you're going to deal with it. And the other side is like, bro, you're like a short-term investor, man. This is nothing. And I'm like, geez, guys, you can't even make a joke without like people on both sides getting angered by it. So that's how like there's this diametric opposition of what's going on. People are like really entrenched in their thoughts. So yeah,
all I see is some really jacked guy in a cowboy uniform. I downgraded my Twitter subscription, so now I'm seeing more ads, and it's kind of freaking annoying because I've gotten so used to not seeing ads. Anyways, thanks Elon Musk. But no, I hear you, man. I mean, it's I don't think anyone really knows what's going to happen, but I think we've been taking the elevator up for the longest time ever, and now we're taking the elevator down, and people just generally aren't used to it. To be honest, though, we're only 4% from the highs, which isn't a lot considering how much we're flat for the year. And that's actually, I think we're kind of like 0.5% down for the year. So are we really down a lot? Like, I mean, I don't know. It feels like it because we're so used to it going up every day, but now we're not going up every day. We're going down every day. We haven't a correction in a long time. I don't know. You think a correction is going to happen?
Well, this is where you have to like take one step back and be like, okay, like what kind of positioning do you have in your portfolio? If majority of your positioning is like tech, right? Then yeah, you're feeling some pain right now. But if you're not in just tech and you're in some of the other parts of the market, you're not doing that bad, So I think the key is the market's just the valuations are just catching up with each other, right? So when valuations go super strong on tech and tech looks like there's going to be a little bit of softness, automatically people are going to be like, hey, listen, I need to rotate into some safety stuff. Like there's plenty of stocks that were up today, so it wasn't like the market is crashing.
Safety.
The challenge is that so much of the market is concentrated in the mega caps that, when they sneeze, everyone feels it. right? Like if you look at a portfolio composition right now, most people probably have, even if they're in an index, they have a good percent of their portfolios in Meta, in Google, in Microsoft, in NVIDIA. But that's because of how indexing works, right? The bigger the market cap, the more representation it gets in your portfolio. So, you know, this is where you have to do a little bit of active management and be like, okay, yeah, you know what? These are also the most profitable companies on the planet right now. So when these things dip, usually all the people who are value investors will start jumping in and buying, and, you know, typically rides up. So I'm not worried in the short, medium, long term. I think everything is fine, especially if your time horizon is long enough. This thing will come and it'll go. You know, the key here is finding the right balance in your portfolio so that you can liquidate some things and buy things when they dip hard. Like for me right now, today I did something in the morning time. I cleared all my SMCI that was short term because I was like, sentiment is flipped. I'm not going to stay in this too long. I think Druckenmiller even said it. Druckenmiller's biggest secret to winning, winning all these years isn't picking the right companies. It's to cancel out the losers way ahead of time. Like, you know, you have to be very ruthless when you're cutting things. And it sucks because sometimes, like, when you cut something and it goes up, it's like you feel like, oh my God, you made a mistake. But it's also something that could protect you. So this morning I woke up, I was like, sentiment on SMCI is flipped. I have 90 days left on some of these contracts. Regardless what happens, sell them. In the morning time, cleared everything. You know, I still have SMCI long term for like 26. Not 2026, 2027, but that's something that I'm not worried about as much. So yeah, so that's what I did. I sold off that stuff in the morning. I sold some of my Brookfield position, not a lot, and I just bought more Google with it, like Google spreads that I have. And I'm literally building this position because the more I get a chance to buy things at a discount, I'm lowering my average. I know Google is not a bullshit company. They're generating tangible revenue. Their cash flows are strong. They're buying back shares. Their profitability is getting better because their margin is expanding. You know, they have this Waymo thing on this side that could probably be $1 trillion idea in the near term. Like if everything scales up, their cloud business is the fastest growing cloud business. So if the market doesn't want to recognize their strength, that's the market's problem, not mine. I think it's a great company. It's going to do fine. There's no data that supports this. AI is like, what is it called? Disrupting search. They're still making more money in search today than they were last year or the year before. So, you know, I think at this point, if ChatGPT and all these guys were really going to be a disruptive, like technology that literally changes how we search, you would see a huge drop off in market share. But I haven't seen that at all. Like it's barely 1% down, and that's like a rounding error for Google. You know, and then Google at the same time is making more money from its AI stuff too. So sorry about that. Go ahead.
No, it's all good. I mean, that Google is actually one of the companies that a lot of my DCAing is going into. I mean, I know you've been bullish on Google for a long time, and to be honest, I got very bullish Google probably at the worst possible time, near its all-time high. But I mean, you know, what can you do? You can't really win them all. But I mean, you know, when I'm thinking about this year, I'm thinking, and I've been very vocal about it, that I am positioned mostly in shares as opposed to 2023 and 2024. 23 and 24 were coming out of a bear market and disbelief that we are in a bull market, and also disbelief that we will not have a recession. Most people thought we were going to have a recession coming 24. 25, everyone is on the other side of the camp. Economists think we're not going to have a recession. In fact, all the S&P 500 targets were like high 6,000s, almost 7,000. Everyone was on the other side coming in 24. In 23, forget about it. Everyone thought we were going to have a bear market still. But 24, we beat the highest price target for the S&P 500 from the biggest analyst firms. Coming into this year, everyone was expecting at least a 10% gain. I'm not saying that that's the reason why I switched, because to be honest, we all made a lot of money in the last 2 years. What am I trying to shoot for coming into 25? Am I really trying to gun for the moon and continue making like ridiculous amounts every year? Or do I want to not be greedy and be fine with my gains right now, minimize my downside, stay in the best company that I could possibly think of? You know, I took a little, it caught me off sides at the beginning of the year. I'm not going to lie. Coming into the beginning of the year, I was positioned a little bit off sides. So I took a little bit of hit in the beginning of the year. I recovered. And then probably in like the last week was when like I really started to understand why I switched into this mindset coming to this year with being mostly in shares, because of the fact that, dude, we cannot stay this greedy where we think we're going to get 25%, 23% in the S&P 500 every single year. We had it coming out of a bear market, which makes sense. I do think we're on an AI evolution still. I do think that we're not going to be in a bear market. I think we're not going to have a recession. I think we're overdue for a 10% correction, but we're only 4% down. And everyone's already scared, right? Like we're like max fear. And when people thought we were at max fear, we're at max fear of the max fear now. And I mean, we'll see what happens tomorrow. Like we're live right now. So, you know, it could be a different story tomorrow. People are watching after the fact. Who the hell knows? But the fact of the matter is that don't expect Amazon to double this year. I'm not expecting it. It's actually still near its all-time highs. Google is not that far from an all-time highs. Maybe it's like around 20% down, but it literally had a massive run in the last 3 months. We're like we're exactly where we were a couple months ago. So it's like, I like, what do you want to expect, you know?
Well, I think what it is when it comes to, you know, companies like Google, Amazon, and everything else, they're presenting really good numbers, right? So that's what confuses people. Like today, Norwegian had its earnings and it was down today, you know, but that's how the market works. Like the challenge is, even if your company is doing good, it doesn't mean that the market is going to reward you. I mean, look at NVIDIA. NVIDIA sold off 8% today with strong earnings. I mean, that's what probably drives people absolutely insane. Like you're thinking, hey, listen, my company that I'm invested in is doing really well. Their earnings are strong. And boom, you see the market and it's like down 8%. Like, how does that make sense? And that's what frustrates people. And I think that's what causes the fear, right? But ultimately, fundamentals are what really shape where you need to go, right? And where the stock is eventually going to go. Regardless of the short-term price movements because of sentiment, ignore that BS. Look at the company. It's like a Peter Lynch thing. Are you using the product? Do you think it's good? Like, is the company, you know, structurally sound? Are they growing constantly? And if you look at it and you take this as a long-term horizon, you're not something you don't have to worry about. And that's why people always say, when in doubt, zoom out, right? And I think that's one of the exercises that we all need to learn how to do. Like, here's an example, and the reason why I added to Google. I mean, I'm not sure if anyone else looks at it like this, but can you see my screen real quick?
Let me throw it on here. There you go.
Okay, so here's the chart for Google. Okay, one of the things that you'll see is certain levels. Like, so fundamentally, Google is a strong company, generating more profits than ever, margins expanding, all that stuff. So fundamentally, this is a good company. So you're not investing in some vaporware company. You don't know if it's making any money or not, if the business model is proven. This is a proven money-making business, okay? So the first thing I look at traditionally is both the 200-day and the 50-day moving averages. And usually you can see a nice pattern develop. So you can see here, every time that Google in the last year has got to that 200-day moving average, it's usually retraced higher right after that. And basically the only time it broke was when we had the whole Japanese yen scare, right? So you can see here on the moving averages, it's getting oversold. So it's moved below its 200-day, right? The question is it going to reverse from here? I don't know. That's something that, you know, we're going to have to see. And usually something like this only happens because either the company reported something that the market didn't like, and then on top of it, to make things worse, the economy or the perception of the economy was weakened, and so people were selling off like the entire market. And so usually when that happens, in my opinion, great companies get oversold, and those are really good buying opportunities. So right now, there's fear in the market. Great company trading below its 200-day, right? Its PE on a forward basis is 18 when traditionally it trades around 22. So you've got room for multiple expansion, and they're projected to grow their EPS between 25 and 30% this year. So you're already on this point where you're like, hey, wait a second, the valuation doesn't, you know, is actually kind of good. It's trading technically at an oversold level. And there's two other factors that you can take a look at, which is RSI and MACD. So RSI, you can see here, usually once it starts to hit the lows around the 30s, that's when you can tell it's oversold. And that's a good time to figure out, like, hey, is this thing going to reverse or not? So when you look at this RSI, how low it's jumped. I mean, how low it's gone down.
Look at the S&P 500
right?
RSI. It's at 9.
Yeah. So that just tells you that there's so much fear that's in the markets. And usually when fear comes around, that means that the market is disconnected from fundamentals, in which case it's the same thing that Buffett says. The market is drunk and it's giving you deals. So have some courage, get those deals while they last. I mean, you can also see here from the selling point from the MACD. The MACD is like just crazy oversold right now.
It's off the chart. It's not even on the chart anymore.
Look at that shit. So it's crazy to see this kind of move, but this is where you have to say, like, okay, you know what? Either you're buying shares or you're buying long-term options on this. Because the thing is, like, doing short-term stuff right now, you don't know when the reverse is going to happen or how long it could consolidate for, right? So like if you look here, this period of consolidation, it consolidated for a really long time before it recovered. So I wouldn't go short dated stuff, but long dated, I expect Google to get back to where it was before, and if not higher. And there's other people that'll look at things like on a channel basis, where they'll do like, you know, these channel lines and saying, oh, look, this is where it is.
Bands, all that stuff. I mean, you can get really technical with it. I think every single technical is going to tell you, like, we're going to go hot, we're going to bounce here. I mean, you know, some people are looking at moving averages, whatever. Like all of a sudden you break the 100-day moving average, you're going to head for the 200-day. That's like, I don't know if I really believe in that sort of stuff. Like that's a little, I get the probabilities and everything, but at the same time, it's like, are you really going to wait for the 200-day moving average to buy something? Especially if it's like a 2-year hold or even a long-term hold behind that. Like, are you going to wait until you hit it, or are you going to DCA into it? For me, it's like, I'm buying more and more and more every single day using whatever cash I have. I'm almost done with all my cash, and I'm supposed to be depositing a lot of money soon. I really hope the market is still down when I do deposit, but if it's not, then maybe I'll wait a little bit, whatever. But at the same time, it's like, dude, the S&P 500 is at a 9 on the RSI. That's from a scale from 0 to 100. The last time it's hit this, actually, hold on a second. I got an image that I want to share right now. Oh, I got to reopen it. Maybe I'll just do it another time.
I think Crossroads said it, right? Crossroads' comment is actually pretty good. It says, better to keep things super simple. Works for me. RSI below 30, and it's not World War III or COVID shutting down. Bye.
Yeah, you know, it's actually pretty funny because, like, I have seen the CNN fear and greed indicator being spammed on my timeline on Twitter since, like, we were at all-time highs, right? So that is not a reliable indicator on its own, right? Like the way that I look at these indicators as far as sentiment goes, especially the AI, actually, I'm going to bring up the AI sentiment survey because this one is like really interesting. AI sentiment survey. Let me.
Also, another thing, I don't know if you saw it, but VIX has also been spiking because of, once again, the fears, right? So let me just bring up the VIX chart.
Wait, check this out real quick. Hold on, I just want to show this one real quick. So this is the AI sentiment survey. They take this every single week, ends on Wednesday night. 19.4% bullish, 60.6% bearish. We have not hit these levels of bearishness since, what was it, 2022? Like, this is getting a little absurd as far as sentiment goes. Because when you really think about it, we're 4% from the all-time highs. Why is everyone so fearful? Like, I feel like we're literally at the same place we were when we started the year. Like, why does everyone think that Earth is going to fall apart right now? I certainly don't think so. But at the same time, I'm not going to bet on calls that are expiring next month, hoping to get the upside. You know, I'm being a little more realistic. I'll share your screen right now.
I think it really comes down to, okay, so this is the VIX, right? So volatility index. So you can see here, usually when these VIX spikes happen, there's a lot of fear in the market. So, you know, the last spike that we saw was in December to January, where, you know, fears came around, but then they dissipate. And this is like a normal part of the market cycle where, you know what, people get scared and it comes back down again. So right now, you know, while everyone is scared, look for those deals that are out there.
Yeah,
the one thing that's an X factor, and I think that's what's driving people a little bit crazy, is the rhetoric from Trump around tariffs, right? So people are just getting really frustrated because they don't know what the real policy is going to be. Like on one day, you're like, I'm going to throw tariffs on Mexico and Canada. And then you're saying, no, I won't. And then you're saying, I'm going to lift sanctions on Venezuela for not taking back more migrants. And then you have a rescue deal with Venezuela where they're saying, we're going to allow more production. So, and now we've got the other catalysts, which are good ones that are coming. Like supposedly Trump got the deal with Ukraine done and they're signing tomorrow, right? So now automatically you're thinking, wait. So what happens to the markets if Ukraine and Russia, if the war ends and now oil prices come down? Like that uncertainty of energy in World War III, if uncertainty goes down, people are going to think Trump is a genius and now the market rides back up again. It's like this weird thing. And then some of the numbers that are going to be coming out in the next probably 3 to 6 months are going to show a lower inflation print, probably because Trump scared the shit out of the market, So businesses right now are probably scaling back, cutting back, laying off, and all those things are going to show up in the next 3 to 6 months. And now everyone's going to be like, oh, look, inflation is gone. Get back into equities.
Yeah, I think that tomorrow's PCE is probably setting up for a pretty crazy bounce. I'm not really going to fall for it. Like, I'm not going to go ahead and chase it. Maybe some short. I have a different time frame than a lot of people. But at the same time, I think tomorrow is setting up for a bounce. You have the 10-year down from 4.8% down to 4.3%. You have all this tariffs being talked about. You have people thinking that we're not going to get any cuts this year. And then comes a cool core PC report, giving the Fed the green light to continue cutting.
I mean, look at this. Look at the 10-year treasury right now. The 10-year treasury in the last 3 months has gone literally from max fear from January 13th, 4.8% to now 4.2%, right? Some of this is definitely just fear in the market driving people to sell equities and get into long duration bonds. So that's probably helping, right? But essentially the goal here is if you do want inflation to come down, one of the targets that Scott Bessent spoke about was getting the 10-year treasury down. Why? It's because now if you do that, you're also stimulating 30-year mortgages to come down as well. So if you look at the 30-year mortgage rate, let me just hold on. You can see it's already starting to make its way down again. Just share. Yeah, it's down. I want to show it, but I can't find a good link to it. But so I think this is the key. And so if inflation starts to come down again, and I think because of all this market uncertainty, it's definitely going to come down some. And the data, it may not appear tomorrow. Because remember, tomorrow's data is reflecting January before all the craziness that we're seeing right now. So maybe around late April, May is when you're going to start to see people be like, oh, you know what? Maybe we're going to get 2 cuts. Oh, maybe we're going to get 3. Maybe we're going to get 4 cuts. And that anticipation of more rate cuts in the future, what does that do? That makes equity prices go the other way. Why? Because as the Fed cuts interest rates, right, that spurs economic growth. And at the same time, a lot of companies that have debt on the balance sheets, they're able to refinance. The companies that are from a multiple standpoint, they start to expand. So this could theoretically be a 4D chess move by Trump and just bringing so much uncertainty that it scares the market into selling off, in which case now consumers scale back, businesses scale back from investing, and you get the disinflation that you wanted,
Yeah, so, I mean, when you think about GDP from perspective, it's highly dependent on the liquidity in the system. And for the US, this is just for our country, it's highly dependent on consumer sentiment. On Tuesday, consumer sentiment came in, it missed by a wide margin. People got scared. People sold off. Walmart last week said that the consumer is slowing down. And then when you think about tariffs is basically a tax. It's a tax on us because these manufacturers, if they get hit with a tax or a higher tariff, they're going to pass those costs on over to us. So whatever we pay for all of our Amazon goods, they're going to be, let's say it's a 5% tariff, we're going to get charged 5% more. That's usually how that thing works. It's a tax that the government is indirectly putting on us dampening liquidity, dampening spending, and therefore slowing inflation and slowing GDP as well. So I think Trump is setting that up as far as sentiment goes, because he hasn't actually done it yet, right?
Mm-hmm. Yeah.
The Fed is going to try to front run that and cut rates sooner, giving into what Trump is doing without actually doing what he's doing. And I don't want people to think like, oh, I think Trump is like a genius, whatever, but like that's a pretty good chess move, in my opinion. I agree with you. That's a really good chess move. I think that was a plan all along. Scott Bissett knew it. Scott Bissett used to work for Stanley Druckenmiller. He is no rookie. He knows what he's doing. He's thinking like he used to be a hedge fund manager for the last 2 decades. And he quit that to become the Secretary of Treasury. He came in with the 3 threes. He wants to get GDP to 3%. He wants to get the debt to GDP ratio down to 3%, which is 3% lower than where it is today. And he also wants to sell, I think, 3 million barrels of oil a day. Whatever that means. I'm not an oil person, so I don't know exactly what that means. My guess is oil is going to end up higher where it is today, but at a 3% GDP and lower debt to GDP ratio. So they have to cut fiscal spending to bring that debt to GDP ratio down while decreasing rates. That is, I think when the Fed comes into this play, Jerome Powell is like, oh, I don't really care what Trump's going to say. But like, no, he does care what Trump says. Because whatever Trump's saying is moving the markets, and the Fed is looking at the bond market, and the bond market's telling the Fed what to do. So yeah, he does kind of care what Trump is saying. In this case, the 10-year is down 50 basis points, which is a very fast, swift move for the 10-year. TLT is on a massive run and stocks are going down. Someone's got to save the market and inject liquidity. The Fed's probably going to cut in March.
Well, even the Fed has already kind of started to loosen a little bit by basically stopping the roll off in its own holdings, right? Yeah. So that's like one thing, but I don't know if you saw this. Take a look at this chart right here real quick. So this is the Fed watch tool.
Oh yeah,
we're trying to predict where the interest rates are going to end up, right? So this is for the end of the year, so December 25th. So in January, so literally 1 month ago, majority of the people were expecting right here, like around, 3.75, right? And basically, people knew that there were going to be cuts, but the amount of cuts that we were going to get wasn't very high. Look at this move towards like a 3.25%. So this is like 4 cuts. It went from 8% to 16%. So it literally doubled in a month. So I think the market is starting to recognize that, we're in for more cuts, not less, especially considering that the market is moving in the way that it's moving right now. So a lot of uncertainty is definitely going to cause people to scale back on spending. And that spending is probably going to end up working in our favor. The other thing is, I don't know if you saw this, but the oil markets have also been somewhat on a downward move. Yeah, there's been like some movements here and there. Let me just right here, bring that up. WTI.
Yeah, crude oil has been pulling back quite a bit amount. People got a little scared for a minute, but now it's coming back to, it was up at 72. It was going up to 80. Yeah. I mean, it's been consolidating for a while, actually.
So if you look year to date at the highs when we started in January 15th, it was about $80 a barrel. Now it's all the way down to 70. Okay. So that's a pretty good amount of movement down. So, and if this whole thing with Russia and Ukraine gets settled, that's just another layer of more production that could probably come on the markets, with some of the sanctions being lifted. I think the Europeans would love that because the Europeans are getting absolutely hammered by high energy prices. So we'll see what happens.
Yep. I mean, oil coming down is definitely deflationary, but I mean, I don't know. You guys were saying that oil is going to drop more. I think it found a base here. And the way that it seems like for the administration is that they want to sell more oil. So we'll see. I mean, if energy becomes a big concern, like if oil drops more and more, like there's going to be a floor. There's definitely going to be a floor when it comes to oil. They're going to refill the SPR and, maybe bring it back up, do whatever they can. Because Biden did unload that entire thing. Did they ever refill it since they unloaded it? Yeah. So Trump's got a big bullet. He's got a bazooka over there. Once he announces that oil is going to rally back up to like 75, but $70 oil sounds about right to me in a disinflationary environment when it comes to technology. Yeah, we're at 70 for crude oil. But I mean, we'll
So
see. Actually, there is this.
here's the
Oh, sorry.
SPR
Go ahead.
levels. Here you go. This is the SPR levels. So
Yeah, they haven't
this
refilled
is
it.
this is the Strategic Petroleum Reserve. Trump basically had it around here, about 600, and like this is a lot. I think it's like 660 some million barrels. And then during the Biden administration, they started to sell a lot of it off to basically control energy prices because of the war in Ukraine, and they're starting to refill it. So it wasn't like the Biden administration wasn't trying to do more purchases, because they were just not doing it at like unreasonable prices, right? So Trump, his goal is to probably get it back to like pre Biden level production. So one of the things that he's probably going to do from a negotiating standpoint with like a lot of the shale drillers is go and say, you know what, y'all need to start drilling, get your shit together, and as they
Drill,
do it, they'll
baby,
just fill up.
drill.
That's right. Drill, baby, drill.
I know that term is so funny, but I mean, it's pretty crazy when you think about it. Getting to 3 million barrels of oil per day, like, dude, that's a lot of oil.
U.S. oil production is at all-time highs right now. I mean, so it's not like we've been sitting on our laurels. Like, no, like U.S. oil production is at the highest point it's ever been.
You're right. It's at 12 million per day.
There you go.
That was my bad. That was 2019. I'm trying.
Yeah.
I mean, honestly, I don't know these numbers. I just know what Scott Percent wants to target.
Mm-hmm. Take a look.
So we'll see.
Look at this. Take a look at this chart. This is the U.S. oil production.
Okay. Yeah.
Monster. We are literally at the top. 13 million barrels a day.
Was it 3?
Say that again.
What was Scott Percent's 3 threes?
No, so it was supposed to be 3 million barrels equivalent. So not just oil, like crude oil production, but also natural gas. Like we are also, if you look at like the amount of natural gas we produce.
Oh, an additional 3 million barrels of oil. That's what he's saying.
Yeah.
Not 3 million. Because I'm like, how the hell am I supposed to get to 3 million? That's crazy.
Yeah.
We're gonna put people out of business.
This is our natural gas production, right? Look at this. So take a look.
Yeah, Gatekeeper's a Chappelle Show fan.
Right here. Look at that. Natural gas production. We're producing more gas than ever. And now with all these export terminals coming on, bro, that's why Trump is saying, I want y'all to drill more. I want more infrastructure going into this thing. And so this way, this raises the GDP of the country, because the more we export, especially natural gas, the more money's coming in to us, So this is where natural gas is going to be a big thing. So the Trump administration, even in the news, it's come out that natural gas is going to be a big thing for them. So right now they've basically loosened all the regulatory agencies to allow for more natural gas exporting terminals to come online at a faster pace, So that's what's happening.
Let's switch things up a little bit, because I definitely wanted to talk about this. Hold on. There's this guy's Consensus Guru's tweet. Shout out to Consensus Guru. This guy releases some really good charts, especially for NVIDIA. So obviously yesterday we had NVIDIA earnings. I wasn't bullish on it. I wasn't bullish coming into it, and I especially was not bullish coming out of it. I told everyone, look, I'm bearish NVIDIA. Like, it's just, I'm bearish NVIDIA because of the fact that I think they're demand capped. And I think that even though they will continue to beat, because they are a rock star company, the amount and degree that they're beating is not as wide as it used to be. They beat by 2.8% on the top line. Next quarter, they're guiding for 1.7% beat. And on top of that, their gross margins are compressing. Handed, though, the CFO did say that they would expand gross margins to 75% in the next few quarters, or by the end of the fiscal year. This is the end of fiscal year 2025. The fiscal year 2026 is going to start next quarter. They said that they will be back to 75% gross margins. I don't think the market believes them. And that's the reason why NVIDIA was down 8 to 9% today, because of that. I think NVIDIA is going to be the leader. They will continue to remain the leader. They will continue to have the leadership when it comes to compute, and they're going to continue scaling on their NVLink or their network broadband cards. but I don't think the demand is through the roof that we've always seen. And I'll take this point. Hold on. Let me share this other chart as well. All right. So this is from 314 research from Warren Pies. Someone reposted it, but this is basically from Warren Pies. And this chart shows this is a 3-month seasonality adjusted. And this chart shows the A100% in minutes per hour where an instance is available. So basically the amount of demand and availability for the A100 chips, which is 2 generations ago. This is also showing the purple for H100, which is last generation, and the current generation Blackwell GH200. This is showing how available it is percentage-wise, right? 100% available for anyone's on-demand use. 0%, like if you want to spin up an instance with this GPU, unavailable, right? If you look at this chart to today, the new Blackwell line, which is supposedly supposed to be very high in demand, is available 100%. Everything else below that, especially the A100s and H100s, is not available. So what this is saying that on public hyperscalers or cloud providers is that the older line of chips are good enough to produce the same output that they did before. And where did this news come to fruition? This news came to fruition with DeepSeek. The biggest narrative with DeepSeek was that you can do what you do today with less. And with that comes, go ahead.
I'm gonna push back a little bit.
Yeah, go for it, man.
I think if you look at the chart, open it back up again.
All right. No, I want to close it because you're gonna push back. No, just kidding.
No. I think what it is what you're seeing at the 100% availability amount is because more and more Blackwell chips are coming online. So demand is just picking up, but at the same time, supply is coming on at a faster pace, right? That's why the availability is so high. No one is adding any more H100s and A100s, right? Because they're like, why are we going to add last generation's worth of chips now? So yeah, availability is going to be going down. To me, this looks like a bullish thing because imagine right now, demand is coming up. Google already said demand is through the roof. Amazon is saying demand is through the roof. Every day, more and more Blackwell chips are coming online, but the minute they come online, they go in full demand mode, but there's another level of more GH200 chips coming online at the same time, right? So what you're seeing here from an availability standpoint is actually like, hey, no one's really adding that many H100s anymore. No one's actually adding any A100s, so their availability is going down. On the other hand, everyone is transitioning to GH200, but the amount of GH200s that are coming online is actually at a really fast pace, or at least that's how I'm seeing this.
Okay, so I'm going to push back on your push. I'm going to push back your pushback, and then I know you're going to push back on my pushback of your pushback. So we're going to keep pushing back. But okay, let me just push back on your pushback. So I think, all right, and this is totally speculative. Like I'm not an AWS engineer. Okay, I'm just a stupid retail trader, and I'm going to do whatever I do. This is not financial advice, but I think that NVIDIA has reached its current valuation in terms of pricing in the future expectations, because this is on a forward PE we're looking at. They're trading at 27 times, which is considerably cheap given its historical forward PE. NVIDIA is cheap today considering historical PE, but that is assuming future expectations. So now my future expectations are that since we can do more with less, we don't need to demand the latest and greatest compute. We can do just as much with the older compute, which is still NVIDIA, according to this chart, the A100s and H100s, in addition to the proprietary chips that Google and Amazon sell. Okay, so you have the Trainium, and then you also have Google's TPUs, right? So if you can do more with the cheaper compute that these companies offer on their proprietary scale, that is better for their business. So if you ask me, am I a buyer of NVIDIA today? No, but I'm a buyer of Google and Amazon for sure. Yeah. They have much higher margins with their own proprietary chips. So in a way I'm pushing back, but in a way I'm pushing up, pushing you forward a little bit.
So here's where this is the evidence that I'll have on it. So let's take a look at this right here. So this just came out not too long ago. There you go, right here. So you can see here Blackwell right now, but from the earnings call, it's ramping up at a really, really fast pace. I'm telling you, the demand for this thing is there, but the supply is also catching up. So this is where you have to ask yourself, like, okay, are more people transitioning from A100 and H100 to Blackwell? Obviously, I think that's the case, especially from an efficiency standpoint, right? Even Google Cloud announced that they were starting instances with Blackwell chips. I think, let me see if I can find it. I had it loaded up, but what's his name? TK Khan from Google. He does a Google Cloud. Damn, what's his name? Basically the head of Google Cloud, proudly went out and said, look, we are deploying more Thomas Kurian. There you go. So Thomas Kurian is the CEO of Google Cloud. Like this guy is freaking brilliant, by the way. He got hired away from
Of course
Oracle.
He's Indian. Of course he's Indian.
Of course he's Indian. Gotta hand it to my brown people, bro. Let's see, where was it? Right here. Excited to share that our new A4X VMs powered by NVIDIA Blackwell are now in preview, right? Where is it? We're the only cloud provider to offer both GB200 and B200 based systems today. And this was February 19th. So like literally a week ago. So all of these new ones are coming online right now. And so that's why you're seeing like, oh my God, look, the availability is 100%. Yeah, because everyone is getting on to, everyone's loading these GB200s right now into their instances. And it's, like I said, there's going to be some time where everyone transitions from the old to the new. So,
yeah, that might be true. There will be a time where the H100 demand becomes the Blackwell demand. But I'm saying according to this chart, okay, and the chart is supporting my thesis, so it might not necessarily be true in everyone's horizon. And to be honest, like I didn't fact check this chart, but the chart is supporting my multiple cases for the thesis.
I think what would be helpful if you had number of GB200s that are currently available. I think if you could find that figure and you can see if there's a huge ramp up in GB200 numbers, then that would solve your question.
Let me,
right? Because what you're seeing is available compute, but you're not seeing total available chips. Or total available.
Oh, I apologize. GH200 is actually Grace. Hold on. Interesting. Okay. So that's actually Grace Hopper. So Grace Hopper is just like a multiple clustered version of the H200. Mm-hmm. So it is not technically Blackwell. So I apologize for that. But the point this is trying to make, because I just realized that I was like, wait, hold on a second. I was just seeing, I thought I saw GB2 one the whole time.
You got live fact check, buddy.
I got fake
news. First of all, fake news.
I fact check myself. Okay. So it is not fake news. I fact check myself. But second of all, the point, it still supports a thesis that you don't need the most powerful compute to do what you already are trying to do based on the fact that there is AI integration efficiency in all this. So I still do think that data center is not going to run as much software.
Bring the chart back up. Yeah, bring the chart back up. Isn't this show then that you're running out of compute because if utilization rates are getting higher and higher, availability is going down? So if you look at availability in 2025 in January, it was at all-time highs. And now after DeepSeek came out, because it's been a month and a half, you're seeing compute levels start like availability go down.
Availability is going down because people are using whatever the older generations were a lot more. This is around when DeepSeek came out. DeepSeek came out like around, well, DeepSeek has actually been out since the end of December, but it became like a big thing in the end of January when the announcement came out and the benchmarks came out. And that's when you literally saw, like, if you look at this, the availability just comes down. But as a matter of fact, like these past two generations, they were not in as high a demand as they are today than they were a couple months ago. But what really changed in the last couple of months? It was DeepSeek. It was the announcement, and it was all of these mega cap companies working to make a much more efficient model ever since DeepSeek came out. And handed, they probably knew about it before that, but at the same time, it was kind of an eye opener. Even Benioff was saying on the call that he doesn't want to really invest that much into CapEx in terms of hardware. He's focusing more on AI integration, which is software. And I told you this earlier.
Yeah. But the thing is, he's been crying about that since December. And I don't know if...
Well, I don't know. Microsoft is cutting back their CapEx spend. I'm not saying it's all going to follow, because at the same time, we had other companies like Meta keep it in line. We had Amazon increase their CapEx. We had Google pretty much increase their CapEx.
Yeah.
Like, it's still going to increase. But okay, Google and Amazon make their own proprietary chips, and that CapEx does not mean data center expansion. It might mean anything that has to do with capital expenditure. So they could be ramping up their own proprietary compute, which obviously is not as good as Blackwell, but it provides people with enough compute to do what they need to do at a more efficient scale. And it's way cheaper for people to use their proprietary chips versus using the latest and the greatest. It's like, I mean, ask yourself, like, what version of the iPhone do you have? Why aren't you getting the 16?
Yeah. I don't know. We got to research this more, because if we're hearing two different conflicting stories. On one hand, you're seeing Amazon and Google, both of them saying we're capacity constrained and we've just got so much demand. And on the other hand, we're seeing Microsoft saying, well, there's not a lot of value, and Benioff saying we're not seeing a lot of value. So the question is, who's telling the truth?
Well, we don't know who's telling the truth. I mean, that's the whole point of investing in the stock market, to kind of put all of your data together and make your own thesis and bet on your own thesis with money. For me, my bet isn't to short NVIDIA. Like, I'm not stupid. Like, NVIDIA is the freaking leader in what it does, and they will always be the leader for as far as I can see. But like, do I think NVIDIA is going to do it 10 times severe? Probably not. And I don't think the market does either. But when I think about like which mega cap am I going to bet on that's producing very high cash flows, it's Google and Amazon. It has been for a while. It used to be Microsoft, but it stopped being Microsoft according to the inflows. And even when you look at it from a perspective of like which company is able to keep their higher gross margins, it kind of looks like it's Google and Amazon. I mean, Meta obviously is a different story, but you know, when you think about like, look at which company is a $3 trillion company today. Still, it's Apple. NVIDIA is not a $3 trillion company. Neither is Microsoft. And I'm not saying that's a telling of the future. What I'm saying is that, like, I don't know, maybe this is just for me. Like, I was a major NVIDIA bull for a while, but I think there's probably better alpha across the list. I mean, I think NVIDIA is going to do great in the long run, but like, it doesn't have that much asymmetric upside as it used to.
For NVIDIA, yeah, I agree. I mean, other than they're just buying back a ton of shares, that's the only thing that's probably
back cap for a reason. Yeah.
And then for me, the challenge is a lot of this stuff can be cyclical, but I don't see the demand drop off anytime soon. At least from
I don't think it's dropping off, but I think when it comes to demand for the latest and greatest, I think that peaked when it came to GPUs.
Yeah.
I mean, there'll always be demand for it. Like, these hyperscalers are always going to buy it hand over fist because they want to have it available. But at the same time, like when it comes to like the amount of demand and price, I don't want to say price gouging levels, but pricing power levels, I think those days at that peak are kind of dissipating at this point.
Yeah. I don't know. I see Google clawing its way through the AI cloud thing, because every day I'm looking and it's just, I see more and more stuff, more and more people partnering. I mean, even Benioff, for all the shit that he says, he's partnered with Google Cloud.
I mean, without a doubt, the cloud is always going to expand. Google's growing at 30%. Microsoft's growing at a high 20%.
No, I'm saying for AI cloud. You know, so Salesforce is like, we're not going to invest in the infrastructure. We're just going to pay Google. Apple did the same thing. Apple's like, we're not going to pay for the infrastructure. We'll just go with Google. So all the new phones that have Apple Intelligence, that's actually run by Google AI Cloud.
There you go.
You know, there you go. So that just goes to show that, Google is doing what it has to do. So,
yeah.
All right,
I mean,
man,
Google's not going anywhere, dude.
I got to head out. So, but yeah, this was fun. We'll touch back soon.
All right. Sounds good, man. Talk to you later. Thanks for attending, guys.